Hey, everybody. So, this is my weekly market update, and this is going to be unusually long because there has been a lot that has gone on in the last week. I'm going to talk to you guys today about several different things. So, I want you to bear with me because everything I'm about to tell you is really, really important. And my goal is to do the best I can to try and tune out the noise that's on the news and that's on the internet, and just try and give you straight talk about what's been happening. This is what let me give you a rundown of what we're going to talk about so you know what to expect. Okay, first thing we're going to talk about is we're going to talk about interest rates, because I know all of you are interested in that, right? Some of you guys are wanting to refinance to lower your monthly payment. And I told you, as long as you're patient, we should be able to do that, right? So I've got good news on that front. Then we're going to talk about what's been going on in the economy and some predictions of some very, very smart economists that I've been listening to. Then we're going to talk about something called forbearance. You guys have seen on the news that, this $2 trillion stimulus package that they're calling the CARE Act, that there is the ability to be able to basically put off making payments on your mortgage for the next 6 months. So I'm going to talk about that too, forbearance, which is probably a new name in your lexicon. Not many people ever heard of that term before. I'm going to laser it out for you. But I think the most important thing that we talk about, first of all, is we talk about what's happened over the last week and what we think is going to happen in the next few weeks, okay? So just bear with me. I promise you it's going to be worth every minute, okay? So first of all, let's talk about the bond market. Now, you guys all know, you're my clients. You've been watching my updates. When you see bonds going up, this is rates going down usually. And then, my God, look at all these huge swings, like over the last week, 2 weeks, three, almost 4 weeks now, 3 weeks for sure. I told you that, interest rates overnight went up from like 3.25 up to 4.25, and even in some cases 4.5 and beyond, because of capacity, right? There was just too many people in the United States were putting in applications, and it was stretching the ability of lenders. It doesn't matter who they were, not us, but everybody couldn't handle it. So the way that they attacked it is they raised the interest rates to slow down the amount of applications. Okay, so what happened also was that all of a sudden the bond market started tanking, because for several different reasons, notwithstanding, people were getting margin calls, and, they had to meet their margin calls because the stock market was tanking. And, we're talking, hedge fund managers and whatnot. They weren't sure as to what was going on. They were scared. And you saw bonds starting to pull back. Now, when a lender locks a rate for you, that's really a promise, okay? There is nothing physically that the lender's doing other than they're coming in, they're saying, I promise you that when we close, when we lock you, you're going to get 3.375 or whatever that amount is. But what happens is that in order to cover them in case rates spike up on them, they go into the options market and they buy options, right? So if rates go up to 4%, or if bonds start tanking and rates go up, well, those options on the bonds will make them whole, so they can still honor that rate to you. We'll see what happened here. So part of the $2 trillion stimulus package was in the CARE Act, was this ability for the Fed to come in and start buying mortgage-backed securities and treasuries to try and stabilize the market, because the last thing they want to see happen is a repeat of 2008. they don't want everybody losing their home. So they came in, they instituted this forbearance thing that I'm going to tell you about in a minute. And they also came in and they said, okay, we're going to start pumping money into the economy, right? That was part of the stimulus package. We called it quantitative easing back, after the collapse. And so what happened is that, they came in and started buying $40 billion a day of bonds, and this was causing bonds to go up. Well, remember, I told you that these lenders have these options in the market to cover their locks, right? Well, the problem wasn't that bonds were going up and they were losing money. The problem was in a day, rates were going up and down so dramatically that it was causing them to get margin calls. Several huge lenders were writing checks out for 50 million, 35 million, 45 million. I'm not going to mention their names, but I know who they are. Just in one day on margin calls, and it was just creating chaos. The Fed was well-intentioned in doing this, but they did it for about a week, and they finally got the message. All the different CEOs of all the banks and all the lenders were going, please stop all the buying, which it's going to put us out of business. So finally, this last week, the Fed got the message. They pulled down the amount that they were buying, and it stabilized the markets. So what we see happening now, folks, is that now look at bonds are still very low right here. As capacity starts to open up and all these loans that were funded before starts to open up, you're going to see rates come back down again on refis. So we anticipate this happening within the next few weeks. So if you filled out the application and you got us all the paperwork in, you are on the top of our list. We're going to be watching the market for you to get you the best rate that we can. And we'll be in touch with you over the next few days to talk about that. Now, there's going to be a lot of companies that are going to go out of business out of this, guys. There's a lot of companies that were really heavy on servicing that aren't going to make it because they just got too many margin calls. We're not one of them. We are very well funded. We were the second largest retail lender in the country. Last year, we did 40 billion in loans. So we are positioned to not only stay in this for the long haul, but to make sure that we do the best job for you. So there's going to be a lot of lenders out there. And I happen to know quite one of the, if not one of the biggest lender in the country. I'm not going to mention their name, but it starts with a Q. I got an email from that was sent to us from our CEO from a client who was promised a 3.5% by this company. And when he went to close, they said, sorry, we can't honor that 3.5%. We're going to give you 4.75%, and we're going to charge you a couple points. We wound up being able to go in there and save this client and be able to, honor a great rate for them. But I'm telling you, you're going to see we're not through the chaos yet. It's still going to get a little dicey. Well, let's get off the rates here. I want to talk about the coronavirus and the economy. I've been sitting in a lot of webinars over the last week with some very, very smart people. Most of the things that I'm telling you are not original ideas of mine. It's because I go to the right people for the right information. And one of the webinars I sat in was a guy by the name of Dave Stevens. Dave was interviewed by our company. He was the senior vice president for Freddie Mac back in 1998 after the collapse. And before the collapse. And then he was also the assistant secretary of housing, the assistant secretary of HUD during the Obama administration after the mortgage collapse in 2009 to 2011. So he knows a thing or two about recessions and about the way that the government looks at the housing market now. And he also was the president of the Mortgage Bankers Association of president and CEO of the MBA, which is a massive association in our industry that's located in Washington, D.C. But at any rate, let me get to what he was talking about. So Dave said that he doesn't believe that you cannot compare what happened in 2008 to what's happening now. Because back in 2008, first of all, that was caused by the mortgage industry, and it threw our government in for a loop. It created a massive chain of events. People were in loans that never should have been in loans. They couldn't afford the mortgages. And as a result, it caused a massive slew of foreclosures, which caused a massive amount of people losing their job. Long term, it took us years to get out of it. This new recession is not caused from mismanagement. It's caused by this virus. Our economy was in really good shape prior to this happening. Although we were due for a recession, we'd been doing well for a very long time. And he believes that once we're able to get back to work, that we will pull ourselves out of this very quickly. And he showed some slides from a gentleman by the name of Mark Zandi from Moody's. And these slides show, where unemployment was prior to this event happening in the second quarter. It started the first quarter, end of the first quarter of this year, but it's really, taking off right now in the second quarter of this year. And it shows a massive spike in unemployment, right? To the tune of over almost 8 million people. It could even be worse than that. But you'll notice that after the second quarter, this represents the second quarter, this massive spike. He believes after the second quarter, once everybody is able, and we're talking maybe July, that you're going to see that people are going to start going back to work. You're going to see people are going to want to go to malls. They're going to want to go to restaurants because they've been cooped up in their house for the last, several months. And he believes that unemployment is going to drop dramatically. This is Mark Zandi's analytics. And you're going to see a huge spike in employment in that third quarter of 2020. And then you're going to see a slow, well, not slow by the standards of what happened in 2008, but over the course of the next year, you're going to, or year to 2 years, you're going to see unemployment is going to go back down again dramatically. They expect to have a vaccine in the next year and a half or so, and they expect employment to pick up fairly nicely. So the next slide that he showed is a slide that shows the housing demand and its drive to purchase growth. So he goes back to, right before the collapse in 2008, because people were buying, you would hear stories of people that were, sorry about hitting that table, guys, that were, their neighbor was buying a house for $500,000 and turning around and flipping it 2 months later for $550,000. And it caused this massive surge in people buying investment properties. And that's what these, the kind of orange reddish line represents. It's showing this massive spike in rental households, percentage-wise, right? And it went all the way into 2015. So, foreclosures were you see a decrease from 2007 all the way to 2011 and even 2012 in owner-occupied properties. People were buying investment properties much more frequently because there was a fire sale on properties because of all the foreclosures. And then you see that owner-occupied purchases started going up fairly dramatically after that, all the way into 2019. So he expects that, because there is the amount of people buying owner-occupied, it's a lot less risky. So you're not going to see the massive decrease in the value of homes. Are there going to be some people that are going to lose their homes? It could happen. It probably will happen to some people, but the Fed coming in and doing this forbearance thing for the next 6 months, it's actually could be up to a year. I think it's 180 days the first time you do it, and then you can go back again and ask for another 180 days. That is the government trying to lock down, people not getting their home foreclosed on. So if you guys are sitting out there thinking, hey, this is terrible what's happening, but, I'm going to wait to buy a house because I think the values are going to go down, I would tell you that you're probably going to be waiting a very long time. There's very little inventory right now, folks. And now with the coronavirus, there's even less inventory. People are not wanting to sell their homes because where are you going to go? Are you going to have a bunch of people walking in your house during an open house to look at your house? So there is some houses still on the market, it's the vacant ones, but there's very little demand. And with interest rates being as low as they are and the Fed intention on keeping rates low for a very long time, the likelihood that you're going to see this massive drop in the value of homes is very unlikely. The last thing that he showed was a slide, again from Moody's, showing you, GDP, what the history was back in 2019, the gross domestic product, which we measure, the success of our economy on. And I don't necessarily agree with these numbers. I think that we put too much value on other things, but it's showing that, we were chugging along, 3% in the first quarter of 19, 2. Now, all of a sudden, in the first quarter of 2020, we see a actual minus. Look at the second quarter, we're at 18%, minus 18% GDP. Well, come on, we know why that is. It's because businesses stopped. Everybody's working from home. But then check this out. In the third quarter, a massive rebound. In the third quarter, Moody's is expecting the economy to rebound very quickly. But I mean, coming from 0 to 100 is going to be easy to do because if we're all going back to work, right? And so this is taking into consideration that they believe that, a lot of people are going to be back to work. And then you'll see the GDP, they expect, into 2002 and 2003 to be very robust, which means, it's not an overnight fix, but the outlook for the economy is very good once we get out of this, home quarantine. Okay. So, lastly, I want to talk to you guys about, here we go. I want to talk to you about the forbearance. So forbearance is when the government is telling lenders that they have to allow you to put your house into forbearance and for it not to hit your credit, and that you're not to be penalized, any kind of fees, and you're not to have any kind of interest rate increase if you choose to go into forbearance. Now, let me tell you my thoughts on this. First of all, just because it doesn't go on your credit doesn't mean there isn't going to be a price to pay on this. So before I go into that, let me tell you what the thing about the forbearance I want you all to be careful about in case you were thinking that you might need forbearance. First of all, I think forbearance is a great thing for some people that are going to absolutely have to have it, right? We don't want the same thing happening to the mortgage industry that happened back in 2008. So I'll say that right off the bat. But here's the thing. If you remember, after 2008, there was a lot of people that were going in and doing these loan modifications. And what wound up happening as a result was that it had it on their credit, and it prevented some people from refinancing later. It hurt their credit for up to 7 years by going into a loan modification. We don't know if that's going to happen in the mortgage industry or not. You could see lenders that could be part of their application process asking you if you ever went into forbearance. Even though it may not be on your credit, they may have that. And if they do, they may wind up putting an overlay in there that you cannot refinance or buy a house at a later date. Okay. So I want you guys, if you're thinking about going into forbearance, here are the three things you need to know. Number one is that you need to find out what are the terms to pay back, right? From what I understand, lenders are being very sketchy about, giving you a straight answer on this. Are they going to make you, let's say that you go into forbearance for 6 months, are they going to make you pay 6 months worth of payments in one lump sum at the end of that 6 months? You need to find that out. You need to get something in writing. Are they going to take that 6 months worth of payments and add it to your monthly payment a little bit at a time over the course of the next several years? You need to find that out before you go into forbearance, because if you're living on a budget that's so tight that you can't afford an extra $400 a month after the forbearance period goes over, then you should think twice about it, right? And the last thing that is that they'll ask you, or what has been floated, is that they might extend your mortgage by 6 months, which would make it the easiest on everybody to be able to get caught up. What I want you guys to understand about forbearance is that all lenders with Fannie Mae and Freddie Mac and Ginnie Mae, what they do is they're loaning you the money, right? And then they go to Fannie and Freddie and Ginnie, and they that loan gets sold to Fannie, Freddie, or Ginnie, so they can keep the market liquid. All lenders do this. Now, some banks will keep a certain portion of the loans in their portfolio. It's called portfolio loans. But even banks like Wells and Citibank, they also sell their loans to Fannie, Freddie, and Ginnie. Now, when you don't make a mortgage payment, I'm sorry, let me take a step back. So those loans get sold to Fannie and Freddie and Ginnie, but you're never writing a check out to Fannie, Freddie, and Ginnie. You're writing a check out to the servicer. When you guys see that your loan is transferred to somebody else, it just means that somebody else is servicing your loan. They're just collecting the money, right, from you. And then they're paying it to Fannie, Freddie, or Ginnie. Unless it's a jumbo loan, it's Fannie, Freddie, or Ginnie. So if you stop making payments on that, they are still responsible for paying Fannie, Freddie, and Ginnie, which means that you don't have to make the payment, but they're still making the payments. Now, they're trying to iron all of this out, but I just want you to understand the mechanics of it. This is why a lot of servicers could go out of business over this. Not to mention the fact, what about your county property taxes? If your taxes are being impounded and those taxes are getting paid by your servicer, who is supposed to be collecting that money from you, if they're not getting any money from you, how's your taxes getting paid? Guys, there are so many layers to this of danger that, I just want you to proceed with caution. Here's my thoughts. If you lose your job, if you are in a position where you have to choose between paying your mortgage and feeding your family, you absolutely should look into forbearance. But if you are in a position where you have to make your mortgage payment, you can make your mortgage payment, I absolutely think you need to make your mortgage payment, okay? There's no financial benefit for you going into forbearance if you can make those mortgage payments, which I think is going to apply to almost all of you. There's some of you that, are self-employed, you can't go out and work. That's a different story. This deal is meant for people like you. But if you've got a job, if you're working from home, if you're on salary, whatever the case is, and you can still make your mortgage payments, folks, you need to do it, okay? We don't know what it's going to do to you later. So I want you to err on the side of caution. So this is way longer than I really wanted to go, but there was so much information that I wanted to go over with you. I just felt it worth to go a little long on this. So I hope I didn't lose you guys. Feel free to reach out to me if you have any questions. We're going to be in touch with the ones that have filled out an application. We're going to be in touch with you over the next several days. Shane and I will be. If you don't have any documentation in, but you did fill out an application, by golly, you need to get that documentation in, because lenders are not going to allow us, include our company, nobody is going to allow you to move forward unless you have all the documentation in and you've proven to be serious about this. So I just hope that everybody's doing okay. I hope all you guys are happy. It's time for all of us to really, kind of just realize what the most important things are to us. The most important things to us should be, I know it is for me, I'll speak for myself, is my family, my friends, people that care about me, my clients. I can't tell you how lucky I feel to be in this position to somehow help somebody, even if it's with just with a little bit of advice. So I hope you guys enjoy the rest of your weekend. Please, if you know anybody that you think would benefit from listening to this, feel free to share this video with them, okay? All right, folks. Sorry for being so long-winded. I hope you got a lot out of it. Take care.